Hello everyone. Greetings from Kotak Mutual Fund. As the Indian economic landscape of growth, stability, and credibility continues to evolve, so has the Indian debt market unveiling distinctive opportunities. To involve you in this opportunity, we are delighted to announce our all-new NFO, Kotak Long Duration Fund. Let's explore why long duration funds are primed to become the cornerstone of a long-term investment strategy. We believe there is a fundamental shift in the macroeconomic landscape of Indian economy. Historically, the country has been overtly punished for twin deficits, that is fiscal and the current account. This was reflected in the INR depreciation and in its sovereign rating as well. However, with evolving fundamental changes in India's growth dynamics and inflation, the economy may witness potentially brighter days ahead compared to its emerging market peers. Friends, when there is a fundamental shift, the impact is not seen immediately, but when it comes, it's meaningful and it sustains for a longer time. Key factors on why we say so: better fiscal management, shrinking deficit in line with FRBM, fiscal responsibility and budget management, with credible numbers and focus on capital expenditure is a positive for bond market. Gross market borrowing, much lower than anticipated, may reduce supply, improving demand-supply dynamics for the Indian bonds. A fiscally prudent budget with focus on capital expenditure helps in containing inflation over long term. If the trend continues, then this may potentially prompt a rating upgrade too. Inflation. The inflation is expected to be in line with RBI's benign print of 4.5% projection for FY25. RBI may adopt a neutral stance by Q1 FY25, following by rate cuts by FY25 over the year. IGB index inclusion. JP Morgan and Bloomberg index inclusion related flows of around $25 billion shall lead to a favorable environment for the bond yields. Additionally, if IGBs make it to the Bloomberg Global Aggregate Bond Index in CY25, the demand for bonds shall experience a further boost. Overall, supply remaining constrained and demand shooting due to factors stated here, we expect a favorable environment for bonds. With expectation of soft landing in the US, we believe that the Fed will commence its rate cuts starting in H2 of calendar year 24. However, in the near term, yields shall remain volatile given the last leg of inflation is always tricky and may throw some tantrums before it may move the further down leg. This may be more a blip rather than change of direction. Based on the stated backdrop, investors may look to increase duration to benefit from higher accrual and potential capital gains. Reversal of interest rate cycle shall lead to capital gains in debt portfolio, and total returns from a fixed income portfolio is likely to be higher than other traditional fixed income options. Hence, we believe this is fundamental shift and long duration is the way to play. Why this fund? Kotak Long Duration Fund invests in instruments such that Macaulay duration of the portfolio is always greater than 7 years. Given that there is a floor on duration but no cap, it is plausible to test waters in very high duration space as and when we believe we are getting instruments at right price. Hence, we may be able to test duration in 13 to 18 year segment as well. For investors aiming to seek a well-diversified, high-quality portfolio predominantly composed of sovereign, AAA, and equivalent rated securities and aiming to lock in higher yields to capitalize on potential capital gains resulting from the rate fall. This fund presents an attractive opportunity. NFO of the scheme opens on 28th of February and closes on 6th of March. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.